Hey everyone, I'm back again with another macro option spotlight. All right, so latest fund manager survey from Bank of America has showing that big tech is extremely crowded. So if we look at this chart, we can see where it was in back in May, and that has doubled in terms of the metric here. So really, really extreme. Now the short US banks, you can see, was pretty crowded, but that's kind of gone away. So we know the short banks has kind of been covered, but the long tech has actually increased, right? And what do we know about crowded trades? When everyone needs to get out the door, it can be a bit ugly. So the last crowded trade we flagged was long gold. If you want to have a look at how that's performed in the last 6 weeks, has not been amazing. Who knows, right? Will tech correct? Feels to me like it should. If we look at the decoupling between the NASDAQ and the 10-year yields as well, we've had 10-year yields, that's inverted obviously, so 10-year yields rising up to like that 385 area, and look at what the NASDAQ's done, right? That was pretty strong relationship for the whole of the last year or two, completely decoupled. Have to put that down to the frenzy into AI stocks and these big cap techs. But we are starting to see a loss in momentum. If you look at the momentum indicators on things like Nvidia, they have somewhat rolled over, even as Nvidia has recovered back towards the highs yesterday. The momentum's nowhere near that. So there is a sign of some potential bearish signals on some of these names. I don't know how far they can drop. I don't know how long it's going to last. It's just right here, right now, I certainly wouldn't be owning them. We've also got Powell speaking today after FOMC. They're going to come out with their new dot plot. That guy, Nicky Leaks, saying the dot plot might need to go higher, even if they are pausing for this meeting. We may well see hawkish revisions in projections. If we were to see that and yields were to push higher, let's say 10-year goes back through 4%, don't expect tech stocks to love that move. Given that everyone owns them already as well, you'd probably expect some of the air to come out of these names. And also the Fed might be looking at some of this speculative behavior in markets. If we look at what the likes of the meme stocks and the most shorted low quality names have been doing recently, they've been actually outperforming the NASDAQ over the last couple of weeks. Morgan Stanley also pointing out that May was the largest month of buying for US stocks since 2010. US long short net leverage is at 12-month highs. We know Skew is back down to its lows, as we've been flagging. So we'd prefer to be buying protection when you can, not when you have to. That's kind of one of those moments right now, we think, right? So I know I might sound like a bit of a perma bear here, but I'm just flagging things look very frothy, okay? And that's the reality of it. So, okay. Moving on, dashboard. So stocks were up after CPI yesterday, came in line to slightly lower, gives the Fed cover for the pause today, as markets expect. Yields, however, after initial knee-jerk lower, did actually end up edging higher due to the idea that we might get a hawkish revision to the dot plots. Precious metals were heavy on the back of that. Energy actually bounced around 3%, both oil and nat gas, and copper was strong as well, adding 2%. So copper kind of decoupling from the precious metals there as the dollar softened. So dollar did come down a little, not massively on the data. And then looking at sectors, we had ARC up once again as Tesla continues to, drive forward. Excuse the pun there. And then XME, metals and mining was up nearly 3% as well. Okay, Skew did ease back a touch. We mentioned S&P Skew bounced. We've got it pulling back about 67 bips there. We did see a bounce in Skew across Russell as well. That had got very, very beaten up as that call bid came in for Russell. So that stuff just kind of mean reverting a little from some of the moves that we've seen recently, but nothing too dramatic. Elsewhere, Skew softening in some of these industrial commodities, the likes of oil down, copper down, uranium down, as those spot levels having a good bounce. And then sector skews were actually quite a bit lower again as well, taking some of these into very low levels, similar to the broader indices. In terms of vols, we did see vols lower, tracking the move higher in spot. Unlike the previous day, we actually said spot up, vol up. But, given this magnitude of the rally, we don't think that move down in volleys is that significant. Fixed strike vols actually still holding pretty well as the street seems to be losing gamma on the rally. Realized vol, though, has been coming down. You can see normalizing a bit, which is why carry has flipped back towards neutral to green across most of the indices. Commodity vols have also been drifting, but not at quite the same pace that we've seen. FX vols and bonds, pretty mixed. No big moves there. Carry-wise, we're still seeing positive carry in bonds. Sectors flipping to mainly positive carry as well. So we are starting to see bits of positive carry coming back, basically saying that the move in implied vols lower was predictive that vols were going to come, that realized vol was going to come back down after we've had this re-rating higher on quite high realized. The market's basically saying, yeah, now that we've had the move up, we're not going to move up at the same velocity. We're going to die a bit of a death here. And that's why vols already reflected that. And now the realized is catching up, right? So you can kind of have that where implied leads realized on the way down. And that's kind of what we've seen. From my perspective, it looks like markets may well be putting in a bit of a local high into OPEX this week. So if you are looking to get short or enter hedges, starting to do it between now and Friday looks to make sense, especially given where we are. And then we'll talk a bit more about ways that you can do that in the trade idea. Okay, so looking at the trade idea and what we're looking at. So we're looking at S&P. So we've been saying that we thought the street was going to lose its gamma on the upside to an extent, and it seems like that is happening. I've got the gamma positioning from Goldman's here. We think peak gamma is kind of past us now as we've pushed on. So we're probably peak gamma is 1 or 2% lower here, whereas you've got this big cliff where the gamma rolls off and goes into short on the upside. We don't think we're necessarily in short gamma yet, but we think a couple of percent higher we may well be if it does push on into Friday. But now that peak is behind us, that peak in gamma, even though some of it's going to roll off on Friday, the big one, that 4,300 to 4,320 area, that 4,320 being the JP Morgan collar strike, that's going to provide the street with some long gamma on the way down. And we think that's going to act as a cushion if the market was to sell back off again, right? So we should expect to find support in that area if the market comes back next week or the week after, okay? We may still need to push higher above 4,400 in the near term, depending on what FOMC, ECB, and Bank of Japan do this week. If they give us an excuse, seems like the market just wants an excuse to rally. So if we don't come out as hawkish as the dot plots, as people are saying, maybe that's going to be the excuse the market needs to rally. Who knows? But we, using extreme cheap vols and skew at the moment to buy puts does look attractive. But funding it with something like the 30th of June seems to be a sensible idea, because the 30th of June, the end of quarter expiries do tend to be quite sticky if you're in the vicinity of those strikes. And we know what strike it is, right? It's very well telegraphed. Everyone knows what the strike is. So that's the thing. So whilst the dashboard is screaming at you to buy puts, here with vols where they are, with spot on the upside on the top Bollinger Band, vols here on the downside, skew here on the lows, term structure, well, just vol in general getting slammed across the curve. It's screaming buy puts now. However, the only one thing that maybe says you might want to wait or you might want to fund them somehow, the vol carry is positive again. Okay, it's in the 70th percentile. So whilst I agree, locking in cheap vol and skew levels maybe a couple of months out looks good here. For the next couple of weeks, I'm not overly convinced we're going to crack down in a meaningful way. So what you could do is the trade idea that I'm suggesting. That's it for today's idea. Thanks again for listening. The throat is slowly getting better. I will catch you guys tomorrow. Cheers.